Hello, good evening. I am just starting the slideshow. So we're on lesson 6 tonight. So this is a disclaimer that, I'm not giving you tax advice uh, through this course. It's not personal, and it's for education purposes only. So the difference when we're looking at a 1040 after we get our adjusted gross income, you will then see the adjustments and deductions. Our objective tonight is to understand the difference between what an adjustment to income is and a deduction. So we have adjustments and then we have deductions. So we want to understand the difference. A deduction is our itemized deduction or a standard deduction. Adjustments are things that we can reduce our income before it becomes taxable. So we want to make sure we accurately report these things. All of these items that we're going to talk about tonight that are what are called write-offs for an individual taxpayer have to be documented. We want to make sure that the taxpayer actually make these contributions, is eligible for these deductions or adjustments to their income. And then we're going to figure out, is it better to take a standard deduction or an itemized? You can only do one or the other. You can either take a standard deduction or you can take an itemized deduction. And everything again has limits and what documents are required. So here on our 1040 on line 9, we got our total income. So the last few weeks we've been talking about income. Now we're going to talk about reducing our income. Line 10 is adjustments to income. And that's from our Schedule 1. So the first part of Schedule 1 was other income. The second part of Schedule 1 is our adjustments to income. And when we subtract that from our total income, we get adjusted gross income, otherwise known as the AGI. AGI is an important number because we're going to use that to calculate other deductions. And then on line 12, we can either take the standard deduction or we can take itemized. And what you want to do is figure out for your taxpayer which is the best. And we're going to talk about tonight what is deductible, what's not. So when we look about adjustments above the line, is they reduce our AGI, and adjustments below the line, if we look back here, the adjustments, the adjusted gross income here on 11, above the line would be our adjustments to income, and then below the line is our standard deduction. So a lot of times you'll hear adjustments above the line or below the line. But for our purposes, we're talking about what are our adjustments to income and then what are our deductions. So here's Schedule 1, which is where you're going to report your adjustments. And we're going to go through a couple of these that are important, that most people have. But these are things that you would adjust your income. So educator expenses, your certain self-employed deductions, retirement contributions are all deductible. Moving expenses are only for members of the armed forces. So we're going to go through a couple of these, but this is where you would put your adjustments. To income, you would total them up, and then line 26 will go back here on line 11, which is our adjustments. So here we have line 10 is our line 26 from our Schedule 1, and then we have our adjusted gross income. So you can so an educator is anyone who's teaching K through 12, not for college professors. A lot of times the college professors will come in and say, I want the educator expense deduction. No, you don't get it. It's up to $300 or $600 for married filing jointly if both are educators. So they have to be teachers, work in a school district. It can be in a private school, but they have to have out of pocket expenses. So they need receipts. We are not auditing our client, so we don't technically have to see the receipts, but we do want to see some form of accounting for these. I have clients who do spreadsheets, and that's an accounting for it. It used to be that educators could take this $300 deduction and then they could itemize their employee expenses. But for federal purposes, you can no longer itemize employee expenses. That means you're employed by someone else, you're employed by the school district, you can't itemize your work expenses. But educators get this special $300 deduction. So another adjustment to your income is your health savings account. So your insurance policy, you have to be in a high deductible plan. And when you pick an insurance policy, it'll say a high deductible plan, you're eligible for an HSA. I love HSAs. They're a triple tax free, they're a very good deduction. But for our purposes, the contributions you put into your HSA are deductible. Now, if your employer puts that money in the W-2 for you, or it is reported on your W-2, and we'll see that in that box 12 where we have all those letters. Letter W is for HSA contributions. Now, your employer can either reduce your income and not be taxable on your W-2, so we don't want to double dip here. So we want to make sure if it's on the W-2, we don't want to put it here on our Schedule 1 because you can't double dip. But if the employee or the taxpayer is contributing themselves to an HSA account, it's deductible. The nice thing, and I'm going to go off topic here a little bit about an HSA, you get to deduct the amount you contribute to the HSA. So that deducts from your income how much you contribute to your HSA. And there's limits of the max amount you can contribute. Now you can put that money in your HSA, and usually it's invested in some kind of mutual fund or some kind of investment vehicle. That money will grow tax free. You do not pay interest on that growth. If you take it out for any medical expense, and you can take it out for buying Band-Aids, over-the-counter medications, prescriptions and doctor visits, any reason you take it out that's medical, it's tax free. You don't pay on the money coming out. Now, if you don't need the money and it stays there, and this is not an expiration like FSA expires at the end of the year, you either use it or lose it. On an HSA, this money can stay in this account forever, basically, and it gets to grow tax free, and you're not taxed on it. After the age, and I'm not quite sure, I should have looked this up, but there's a certain age, it's either 62 or 65, you can take the money out of your HSA tax free. So as long as you leave that money there for till you reach a certain age, you can then take the money, withdraw the money from your HSA tax free. But at any point in time, you can use this money for medical expenses and it's tax free. You can withdraw it. So HSA, we call it triple tax free. You get tax break when you contribute it. It gets to grow tax free. And then number 3, when you take the money out, it's tax free. So HSA, if you are, but you have to be in a high deductible medical plan. If you're in a high deductible medical plan and you pay your health expenses out of your other money, but you still put money in this HSA and you just let it sit there, one of the things that people use this as a vehicle to save money. So as long as they have money somewhere else, pay whatever they use for their medical expenses because you have a high deductible. High deductible is usually over $5,000, $7,000. So your first $5,000 to $7,000 of medical expenses come out of pocket, but you can contribute to this HSA. And you can take the money out then and pay for your medical expenses when you're in a high deductible plan. So IRA, one of the things, if you're in an IRA with your employer, the taxpayer is in a retirement plan with their employer, they cannot contribute to an IRA, regular IRA. They can, with limits, contribute to a Roth IRA, but not to a traditional. And there's phase outs. So right now you can deduct $7,000 or $8,000 if you're over 50. Every year this gets adjusted. But your IRA deduction is you can deduct this, and again, this comes if you contribute $7,000 to your IRA, $7,000 of your income is reduced. Student loan interest, you can deduct up to $2,500 on your student loan. And this is on the interest that you pay on your student loan. Now there's phase outs that for 2025. So this is going to be reported on 1098E. If someone has paid on their student loan, the portion of their student loan payment that is for interest is deductible. If their income is over 85 to 100,000 for a single head of household qualifying widow, there's a phase out. Over $100,000, you cannot take a student loan interest deduction. Married filing jointly, it goes up to 170 to 200,000, and this is for 2025. So you can take a student loan, your interest payments on your student loans are deductible, unless your income is over these amounts. So another adjustment that we're going to see a lot of is self-employment adjustment. So when someone is self-employed, they're going to file a Schedule C. There are special retirement plans. Now, a self-employed person can contribute to a regular IRA. But if they want to contribute more than $7,000, they can contribute to a SEP IRA. They can contribute to a solo 401k. There's all kinds of limits, and SEP IRA, they can contribute 25% of the net income. So self-employed, they're going to pay 15% Medicare and Social Security tax. Those two taxes together equal about 15%. Once someone makes over $400 in their business, it's subject to self-employment tax. And self-employment tax is, again, the Medicare and FICA portion that the employee pays and the employer pays. But if you're self-employed, you get the pleasure of paying the entire tax. But once you pay that full self-employment tax, half of that amount is deducted as a reduction to your income. And then you're self-employed. If you're self-employed, you pay for your own health insurance. That also will reduce your income. And then I just talked about the retirement contributions. So those are the adjustments, and then we go into deductions. We have two types of deductions. First type is standard, and then we have itemized. In the past 5 years, they've changed a lot of these itemized deductions. You used to be able to write off your employee expenses. You can no longer write those off. So we calculate for our clients what their itemized deductions are, and then we're going to take one or the other. You can't take both. A lot of clients will say, well, where did you put my charitable? I gave $125 to charity. Where is it? It's well, the standard deduction was much higher than your $125 deduction. So we'll figure that out, and we're going to use Schedule A. But you can use, again, the standard or the itemized, and we're going to figure out the itemized deductions. Here are the standards. These are for 2025. Again, this is not finalized at today's printing, but we're going to assume these for our examples. Is the standard deduction if you're single, 14,600. Married filing jointly is 29,200. Head of household, 21,900, and married filing separate, 14,600. So if you have somebody who's a W-2 earner, they rent an apartment, and their employer gives them health insurance, they're gonna take a standard deduction of $14,600. So again, the first $14,600 that they earn is deductible. It would bring if they only earn 16,000 or 14,600, it would bring their taxable income down to zero. So if you're blind, if you are blind and over 65, there's an additional $1,950 for either of those. And if you're 65 and you're married filing joint, you're married filing separate, you each would get an extra, each taxpayer would get an additional $1,550. So these are your standard deductions. So you can either take a standard deduction or we can itemize. And when do we itemize? We itemize when it's larger than our standard deduction. So we would take all of our itemizations. So this is Schedule A, and it gets attached to your 1040. So this is going to list, and we're going to go talk about all our itemized deductions. And this is where we're going to talk about medical, taxes you paid, interest you paid, gifts to charity, casualty, loss, and theft, other itemized deductions, miscellaneous, and then the total. So that's the Schedule A. You can go to irs.gov, and that's where I got this, and that's our last year's, our 2024 Schedule A. Okay, so when do we itemize? And let's see so we itemize when it's larger than a standard deduction. It's kind of a concept people kind of get confused. A lot of taxpayers are confused. They use wrong language, and they'll often ask, where are my itemized deductions? So I print for every client a copy of the Schedule A, even if they take the standard deduction, because then they can see that their itemized deductions were less than their standard deduction. So we're going to take a deep dive here into our itemized, and we're going to start with medical. So the medical deductions, your medical expenses have to be greater than 7.5% of your adjusted gross income. So again, we're going to go back to our 1040. Now that we had our reductions to income, we can now figure out what our adjusted gross income is and take 7.5%. And that's why you have to figure those first, because now we need to know what is 7.5% of our adjusted gross income. So if someone makes $50,000, 7.5% is 3,750. So if they had medical expenses of 3,760, they would only get $10. So it's above the amount that exceeds 7.5% of your adjusted gross income. And this is for prescriptions, doctors, dentists, chiropractors, mental health, Medicare premiums, transportation, mileage, if you need to use an ambulance, if you need to use an Uber, parking, this is anything medical expenses. You can also, depending on your age, deduct partial amount of long-term health care. If you're not self-employed and you pay your own health care premiums, you can deduct them as well. So this is all medical expenses. So you have to figure first what someone's AGI and then times 7.5%, and then only over that. Here on our Schedule A, you can see that we're going to put here all our medical and dental expenses, eyeglasses, all of those things will go on line 1. And then we're going to enter the amount of 1040 line 11, which is our adjusted gross income. And then we're going to multiply line 2 by 7.5%, 0.075. And then we're going to subtract that from our medical expenses. And that becomes the amount that we can deduct on line 4. So that's medical. Questions on medical? If you have to have a nurse come in your home, that's deductible. You have to buy a wheelchair, that's deductible. So medical expenses are pretty broad. Now, there's certain anything over the counter, like a vitamin, is not deductible. So you want to make sure it is a qualified medical expense. So this is called the SALT tax. SALT tax is your state and local taxes, and SALT tax. You'll hear a lot about the SALT tax. It's just changed under our current administration, so it is a big deal right now. What's happening with the SALT tax? It went from in 2024 $10,000 to 2025 $40,000. And what that means, you can deduct up to $40,000 in 2025 of state income tax, local tax, wage tax, real estate tax, and personal property. We don't see a lot of personal property in this part of Pennsylvania, but we see state income tax. So that amount of around 3% that's withheld from your wages that are paid into Pennsylvania are deductible under this SALT tax. So it's your wage tax. It's also local. In Philadelphia, we have a local Philadelphia wage tax. That's included. Your real estate tax and personal property. So what was happening, especially if you're in New Jersey, your real estate tax is over 10,000. And if you're working and you're making 60, 70, 80,000 a year, your state tax and your local tax, wage tax, you're way over the 10,000. So it was limited to the 10,000. It really eliminated people itemizing their deductions. But now, with the increase, so in 2025, we're going to see many more people itemizing because they can itemize more things. They'll have their wage tax, their income, their state income tax, and their real estate tax. So if somebody owns a property, and they're working and their spouse is working, they're going to come close to $40,000 in taxes. And depending where they live, or even in the suburbs of Philadelphia, real estate taxes can be quite high. The average, I think, in Philadelphia probably averages around 1,500 on the low end and up to about 3,000. Philadelphia really is uh, a reasonable uh, city to live in as far as real estate taxes go. New Jersey, you're going to start on a low end of real estate taxes at around 10,000, and these are just what I've seen. So don't quote me on these, but they're you know New Jersey, certain areas outside of the city, and a lot of times people with children move outside of the city. The schools are better, real estate taxes is higher, so you switch one for the other. So you add all of these taxes together, and the first up to $40,000 can be deducted. The next area you can deduct is mortgage interest. It's going to be reported on this form 1098. Box 1, we're going to see the mortgage interest received. This is the amount when somebody pays their mortgage. Portion of their mortgage is interest. The other is principal. The other parts might be for your homeowner's insurance. So we need to separate the parts. The mortgage companies do this for us. Somebody is deducting mortgage interest. They need to have this form 1098. We need to see this. So the other things you're going to see on this is your outstanding mortgage principal, the mortgage origination date, and mortgage insurance premiums. Points paid. So if somebody just is buying a home, a lot of times you'll pay points, and these are deductible. Often you will see real estate taxes. If real estate taxes are a part of the mortgage payment, they will be included in this form. So we want to look at this, and it's important. Oftentimes people will refinance their house and they'll get a new mortgage. So maybe they buy their house in 1987, but in 2020, they ran up all their credit cards and they refinanced and they took out more money so that they could pay off debt. The house went up in value, there was more. We have to prorate the amount because the only mortgage interest deductible is for that of the property or if they take a home equity loan to improve the property. Those are the only mortgages deductible. So if someone takes a home equity loan out to pay off credit card debt, it is not deductible. Or if they take a home equity loan to go on a vacation, not deductible. But if they take a home equity loan out to put in a new kitchen, it is deductible. So it has to be used to improve this property, the primary residence. So you'll see times where people have their first mortgage, which will be, they'll receive two 1098s, one from the first mortgage, one from the second mortgage. Okay, the other thing on our itemized is charity. When you give to charity, you can give cash, checks, Venmo. You can give Venmo's cash or checks. You can also donate items to the Goodwill, your used clothing. There are worksheets, and I have some clients who give quite a bit, and they have children, and every year the children outgrow things. They keep a spreadsheet of what it is, and any donation of goods you can write off at the fair market or thrift value. Salvation Army puts it out every year on their website, so you can go to their website and see what is the value of a used t-shirt. So when you donate a trash bag full of clothing, you should do an inventory and say, okay, there was 3 t-shirts, 4 pair of jeans, and a pair of cowboy boots. And then you want to go on Salvation Army or Goodwill's website, and there's a fair market value of used clothing. If a parent passes away or a parent moves, downsizes, and you donate all of those items to Goodwill or they come and they pick them up, you want to get a receipt because anything over $250 you have to substantiate. If you donate a car, because that was a big thing, is people would donate a car that didn't run, but then say, oh, it had a value of $5,000. So now cars are very limited and you have to use the Kelley Blue Book value. But if you donate, an old stereo, a historic, something to a historic museum, if your family has a historic, uh, an old valuable record or, anything like that, that is over $250, you need a record. You need a receipt. So every time you go to Goodwill, Salvation Army, you want to get a receipt. And they'll ask, write down everything that's you donated. And then, all the household goods you donated and put a value, fair market value on that. Sometimes they will do it, oftentimes they don't. So you want to be doing it and using some kind of formula. The thing with the IRS is that you get audited on these, and these are one area that you can get audited. That can be a red flag. So if you have someone with a high charitable contribution one year that's out of the norm, they might question it, and especially if it's has a few donations that are over $250. You want to explain. When my mother-in-law went into assisted living, we donated a lot of clothing, and some of her clothing were brand new. So we listed how many shirts, how many pants, how many brand new, unused pieces of clothing, wheelchairs, all of those things that oftentimes the next generation is going to be donating. They don't want our stuff. When we pass, they're going to just donate it. They want to keep receipts because those things, when you're donating large households, they can add up. Or if you want to clean your house out and buy all new furniture, and I've seen clients do that, they're going to move, so they just donate all their furniture. So they want to get a receipt because the value of that's going to be over $250. If you donate, I donated old uh, photography equipment. And when I did, I took pictures of it. I got values, fair market values of it, and keep it. If you donate something, an antique or something of huge value, of pretty substantial value, you want to get it appraised. And you can donate that at the appraisal value. You can also donate, and part of this over $250 is you can donate stocks and bonds and investment vehicles. It's one of the ways to get out of capital gains. It's a great way to save money. So if you buy a stock from ABC Company for $100 and you hold it, and now you want to give your church $500, and the stock is now valued at $500. You can donate that $500 stock to the church. Now you have to transfer the stock of $500 to the church or to your nonprofit, and then you get a write-off of $500. You do not have to claim, because normally if you buy a stock for $100, it's now worth $500. You'd have a $400 capital gain, and you would have to claim that as income. But if you donate it, and you want to make sure any organization you donate to is truly a 501c3. And you can go to the IRS website and they will tell you they're a real charity or they're not. There are charities around that claim to be a charity and are not a charity. If you give money at the 7-Eleven when you go in for coffee and they ask you for $1, you give $1 to a homeless person, not a write-off. If you buy someone a tent to live in, not a write-off. If you bring meals to someone from your church, when they're going through a rough time, not a write-off. You have to give the gift to a charitable organization. You can give goods and services. So oftentimes we'll see at this time of year, where you can buy gloves and hats and coats for children and for adults who need them, who need to keep warm through the winter. You can buy those items, and at your purchase price, if you buy a coat for $120 and you donate it to a qualified charity, then that coat is a write-off. If you take that coat and you go down on Market Street and you hand it to someone, it is not a write-off. So you want to make sure, and especially if it's over, and it's the total of your donation. So if you give $100 here, $20 there, $30 there, and it's going to add up to more than $250, or you give, 5 times a year, you clean out your closets and you're giving large bags of used clothing to the Goodwill, you want to get receipts. Because again, if it's over $250, we have to itemize those donated goods. Cash, you have to keep the receipts for your records. We don't need them for the tax purposes, but we have to list the organization. So any donation over $250. So, if I give $100 to this organization, 25 to the cancer, and somebody else goes on a walk, all of those are deductible. But I need receipts, but I don't have to list them separately. But if I give more than $250, I have to list, the organization.
Pero no creo que ahora muchas personas hagan pues ese tipo de donaciones tan grandes, o si las hay.
But I don't think that many people make that type of large donations now, or if there are any.
Yeah, right. I think that I've found some people donate heavily. And I remember having a woman who made $30,000 a year, and she was a single mother, and she donated 10% to her church. Amazingly, she always brought me a gift. Like, she was a very generous woman, but she was very committed to 10% of her income went to the church. So there are still some people who really do donate. So you want to keep track of that. You have families where both parents work and children grow, and they give the clothing to the organization. Then that adds up, with kids' clothing and stuff, toys. As you know, we just gave a bag. We had toys for our grandchild. The grandchildren are grown now, or older. But we gave them to a friend who just had a child. Had we given them to an organization, we could have written those off. So it's always a choice, So yes, not as many people give as they used to, but I think there's still a good portion of our tax clients we see that do give some money, and it doesn't depend on income, because I've had another client where a couple, they both earned over, and this was a number of years ago, so they were earning both over 150,000 each, so they had $300,000 in their home. And people ask you, what's the maximum I can take? Well, there's no maximum. You can only take what you actually give. So they wanted to take the maximum, and I was like, there is no maximum. How much money did you give? And they didn't give any, but they wanted to take this deduction. So, so there's people with, making a decent amount of money who don't give anything, and then you have a single mom with 30,000 who does give. So it's really, yeah, it's kind of, you can't tell who gives and who doesn't. It's amazing. So, all right. So so those are all our deductions. if we were gonna itemize. So the other itemizations that you can do, they're not as well, and there's other ones that we're not gonna go into, but if there's a casualty or theft loss, it has to be a federally declared disaster area. So this is a new law. Like you used to be able, if you had a loss, somebody stole your car and you didn't have insurance to replace it, you could deduct it. No longer. It has to be a federally declared disaster area. Like when there's a flood and the government comes in and says, hey, this is a disaster area. And in gambling, so if you gamble and you win money, you have to claim it. When we saw it on this other income parts, this gambling income, we have to claim when we hit the lottery. We have to claim that money, but you can only deduct your losses up to the winnings. So if you win $2,000, but you gambled 5,000, you can only deduct 2,000. So your gambling losses are only up to your winnings. So if you hit the lottery, and you have to save all those lottery tickets, and if you ever see people, and I've had clients who are lottery players, they collect all their lottery tickets because they know the day they're going to hit the lottery, they need all those lottery tickets, and it's only in that year. So if you hit the lottery in 2025, you can only deduct the gambling expenses you had in 2025. Because taxpayers, individual taxpayers are on a cash basis. From January to December, whatever happens in that year, what they receive or they spend, happens in the year. So we want to talk about documenting everything. So you want to have receipts for any charitable over $250. Mortgage statements, 1098s, medical miles. Do they have a log? How are they doing? You want to ask as a paid tax professional, you're going to ask your client probing questions. How much, if they say, I gave a bag of clothing, you can't just write off a bag of clothing. Well, how much was the clothing worth? If it was under $250, you don't need to see the receipt. If it's over $250, you need to see the receipt, and you need to write in on the tax return the name of the organization, their EIN number, their address, all of that, the purchase price. So let's say I'm giving, an expensive fur coat to Goodwill. My purchase price was $10,000, but it has a stain on it or it has a mark. Maybe it's only worth $300 now. I still have to list when I purchased it, what my purchase price was. So if you buy expensive items and you think you're going to donate them, you want to keep some kind of receipt, or you would go and get it appraised. If my $10,000 coat is still worth $10,000, it's in great shape. And some things go up in value. Maybe it went up in value. We would want to have it appraised. Or you'd want a receipt from an organization saying, yes, it is worth $10,000. A lot of times, art donations, when people donate art, it can get convoluted. And you're going to run into this if somebody is an artist and they want to donate their artwork and want to write off as a charitable contribution. If they've already written off the paint supplies in their business, they can't write it off as a charitable. And when you give something like that, a piece of art as a charitable, it's not a deduction. But if I go out and I buy a piece of art and I donate it, 10 years later, I'm like, I don't like this piece of art anymore. This painting doesn't talk to me anymore, and I'm going to donate it. It might be worth some money, and I would want to get that appraised. If I donate it to the Philadelphia Art Museum, they may give me a receipt that says, hey, it is worth this amount of money. You can give things to and again, go to the IRS website. I've had clients give to certain organizations where I was like, I never heard of this charity. Most of them, we hear Goodwill, we hear different churches, and I've gone to the website and seen if they were a viable charitable organization. 501(c)(3) is the tax code, and they were. One wasn't, so I had to tell the client, no, that's not. And again, people will want to say, I gave money to somebody's GoFundMe. GoFundMe is not a charity. It's nice that you're giving your friends some money, or somebody has a fire and they're trying to get money together. I had a client whose barn burned down. We all gave some money for their barn repair. Not a charitable contribution. It's a gift. If you receive money from a GoFundMe, if you're the one that, they did a GoFundMe so that I can have another vacation, I have to claim that money as income. If you receive GoFundMe money, it's income. If you give money to a GoFundMe, it is a gift. So gifts are not deductible. All right, so we're gonna here's some IRS references that we talked about. Is a circular 230, which is our due diligence. Pub 17, we're in chapter 16 through 20. Pub 969 talks all about HSAs, and Pub 590 will talk about the IRAs. And then you have the Schedule A. They have a whole instruction manual for Schedule A. So we want to do a case study tonight. And this is, John and Mary Sample. They're married, they're filing jointly. But so case study here is we're going to file 1040 in a Schedule A, possibly for this taxpayer. So they're W-2 earners. They have interest of $220. They have an IRA deduction, which we know is a adjustment to income. Okay. So if we take 82,000 plus 220, and then we subtract 4,000, now we have an adjusted gross income of 78,220. Do you see that? All right, so you're going to take the wages of 82,000 plus $220 of interest, subtract the 4,000 because our IRA deduction is an adjustment to our income. And that's going to give us an AGI, an adjusted gross income of 78,220. Okay. So this is the first half of your 1040 we knew as our income. This is what and then today we learned about adjustments to income, the IRA deduction, and then we get to our adjusted gross income. So we're going to have our Schedule A breakdown. So we're going to either itemize or take the standard deduction. So Schedule A breakdown or itemization is medical expenses of $8,100. Now, what is 7.5% of our adjusted gross income? So we have to go back. Our adjusted gross income is $78,220. So our adjusted gross income, 7.5% of that. So this part here. So the deductible proportion is over 7.5% of the AGI. So the 7.5% of the AGI is $5,866.50. then we would take that from the 8,100. And we would get $2,233. So the deductible portion of that is only $2,233. Now their state and local taxes that they paid was $6,200. So if it was 46,200, they could only deduct 40,000. But it's under what our SALT limitation of 40,000, so they can deduct the entire 6,200. Mortgage interest, 7,500 is deductible, and they made charitable contributions in the amount of $2,200. So we want to see, and if we remember, what was our standard deduction for married filing jointly? Was I'm gonna say our standard deduction was, I think, 9,000. The standard deduction was 29,200. So we want to now add up our Schedule A. So the medical of 8,100, only $2,233 are deductible. State and local, 6,200. Mortgage interest, 7,500. Charitable, 2,200. So their total deductions are this here group, which adds up to $18,133. Is their itemized. So they don't get the whole medical, they only get over 7.5%. So we have to take their AGI times 7.5%. And then you subtract that, and then you get this. This is over the 7.5%, is the $2,233. So this totals $18,133. And then we look at the standard deduction for married filing jointly of $29,200 versus the itemized of $18,133. We want to use this standard deduction. So all of the charity that they gave, all their medical expenses they had, all of that doesn't really matter. They're going to get the same amount as someone who had none of those. They're going to get this $29,200 because you want to take the larger deduction. So when we have wages of 82, we have $220 in interest. We have an AGI because they gave 4,000 to their IRA. So we brought our AGI down to 78,220. The standard deduction of 29,200 gives us a taxable income of $49,020. And that brings us to the end of the first page of our 1040. So when we're looking at our, I wanted to get a 1040 up for you.
One question.
Yeah, go ahead.
Igual la mayoría de esos datos los da el software directamente.
Maybe most of this data is given directly by the software.
Yes or no?
Yes, most of this you're going to give the software, but you have to understand how it works. So you can explain it to your client. When they say, why didn't you itemize? You got to understand that, here, hey, look, your itemized are 18,000. And that's why I give my clients the Schedule A, which is our itemized. But yes, you're right. Your software is going to do a lot of this for you. But you have to understand where it comes from.
Okay.
So we're practicing this here as understand. This is a theory of it. We're learning in this class is theory and to understand some of what's behind it. You can plug numbers into a computer, but if you don't understand it, you can't explain it to your client. And you can't see, today we had an example, I gave a client a tax return that, oh, wait, there was some stuff that we could do differently for that taxpayer. So you're learning, this is just a real basics class. And you need to learn a theory like what the AGI is, because if we want to learn some tax strategies and stuff like that to help our clients save money, legally save money and stay in compliance with the IRS, we have to know these things. So this is basic.
Okay.
Yeah, but yes, you're right. The computer, the software will figure out the 7.5% of your AGI. It'll figure that out for you. You don't have to figure that. But I want you to understand it so you can explain it to your client if there's an issue. So I'm going to share with you now the 1040. I want to show you what we've learned so far, kind of a little review here, is, we've learned basically how to fill out our name, social security number, filing statuses, what they were, digital assets. And then this is going to help figure out our standard deduction. Can someone else claim us? And if your spouse itemizes, you have to itemize. If you're filing separately, married filing separately, if one spouse itemizes, the other has to itemize. So you have to do the same thing. And oftentimes, if one spouse has a lot of itemized deductions and the other doesn't, it can really hurt the one that doesn't have the itemized. Because they don't. So if you're married filing separate, and again, we're going to go over this again, over and over. Married filing separate is a difficult itemization, is a difficult filing status, because when one spouse does something, the other has, then you eliminate certain things. So if you have a spouse, they're separated, one donates a lot of money, they have high medical expenses, they have a large amount of itemizations, and the other rents, has no real, has basically a W-2 income, they're going to have minimal deductions, but that's all the deductions they will get if the one spouse itemizes, the other has to. So that's why you really get penalized filing separate. So we learned about dependents, who's your dependent, who's not. And then we learned about income, this first part. And we're just going down through this 1040. We learned about interest, dividends, qualified dividends versus ordinary dividends. We learned about IRA and retirement funds, pensions, annuities, taxable, not taxable, Social Security benefits. How much of them are taxable or not taxable? We didn't do a lot of capital gains. That's kind of more advanced, but this is where capital gains would be reported. And again, this is all income. And then we have the Schedule 1, page 1, the first half of that talks about other income, jury duty, other incomes. Sometimes you might receive money from gambling. You would put this on your Schedule 1. And then that income would go here. And this would be where we started tonight. We spend, a couple of nights on this different sources of income. And then we got here to our total income. And then we talked about our adjustments, which is the second page of Schedule 1. Schedule 1 is 2 pages. First page is income and the second page is adjustments. And then after we get to the adjustments we get are adjusted gross income, and that's where we're gonna take that number times 7.5% of your AGI. Over that will be your healthcare medical deductions on your Schedule A. So you can take either those Schedule A deductions, or you can take a standard deduction. So we're gonna figure it out. You know, if people give us, our clients give us this information, we'll calculate it. Oftentimes, they don't qualify for itemizing. 80% of the time, if a person does not own a home and have real estate taxes and mortgage interest, they don't usually qualify. But there's times where someone has extreme medical expenses that aren't paid by health insurance, and they have to pay them out of pocket. If someone's in assisted living, that's an expense they're paying out of pocket, and that can be anywhere from 6,000-7,000 a month up to 15,000 I've seen. So for assisted living, and that adds up if they're there for a year. So then we get, you know, after we get our itemized, and this is for a business, we're not gonna get into the qualified business income deduction. That's again like a Schedule D capital gains, it's more advanced. We're focused on an individual taxpayer, basic tax returns. So that brings us down here to the end of page 1 of our 1040, and that's our line 15, which is our taxable income. Now, on Thursday, we will start talking about tax, how much tax, what taxes get paid, what don't. So we're going to talk about that, and then we're going to talk about payments in. So we only have a couple more weeks left, and we're going to, you know, and we've talked a little bit about on this page 2 of our 1040 about taxes that we paid in, how to figure out a refund or do they owe us money. And so tomorrow night, I'm not giving you homework because we're like 3 nights in a row. We're Tuesday, Wednesday, Thursday. So you have to get a PTIN. It's a Preparer Taxpayer Identification Number. PTIN, so you have to register for this. If you want to be a paid tax preparer, you need a PTIN.
Sí, estoy trabajando en eso.
Yeah, I'm working on it.
Okay, great.
Okay.
Yeah.
Yes.
So you want to go here and you want to create an account.
Ajá.
And then you're going to say you will prepare U.S. federal tax returns for compensation.
Okay.
Yeah.
Oh,